Good morning, everyone. So this session is completely being centered around towards making you understand the valuation metrics, right? So in the previous session, we have talked about the price to earning ratio. What exactly is the price to earning ratio? We talked about the various advantages and also discussed upon certain disadvantages of the price to earning ratio. And then we talked about the price earning growth ratio that tries to overcome the limitations of the price to earning ratio. Then we also talked about the price to book value ratio in detail. So all these ratios, they've tried to understand from a practical perspective, from a practical viewpoint, how an equity research analyst or a valuation research analyst or a financial modeling expert is using these valuation ratios to make out interpretations from the market, to base out his forward outlook about these multiples, about the valuations, be it overvaluation, undervalued, or the fair valuation about the markets, and all those kinds of different connotations or interpretation these guys tend to make. This session, as promised, will talk about the EV to EBITDA ratio. And if we have time, then we shall also be trying to discuss about some other variants of the EV to EBITDA ratio, that is adjusted EBITDA. We'll also try to talk about the price to sales ratio, EV to sales ratio, sales to capital ratios, and various other types of valuation metrics in the further subsequent sessions, right? So I'll just start sharing my screen as well. And I hope the whiteboard shall be visible to everybody. And here today we discuss about the EV to EBITDA ratio, a very important ratio. And again, we'll try to understand this metric from a practical viewpoint, as we understood the previous other valuation metrics as well, be it the price to earning, the price earning growth ratio, the price to book value ratio. So all those things we try to understand in a very deep dive manner. So for all of those who have still not attended those sessions upon price to earning, price earning growth, and price to book value, just go back and watch those on the YouTube channel, like which are freely available for every one of you to access them freely and get the full-fledged practical and conceptual interpretation of all those valuation ratios. So coming back to this EV to EBITDA. So firstly, we'll try to understand the two components, the two most important components like which are used in this ratio. Again, it's a fraction, right? So if we talk about the numerator, so EV stands for enterprise value. E stands for enterprise and V stands for value. The many of you might know it already, but I will just try to keep it very basic for everybody because many of the audience of our YouTube channel are someone who are completely new in this valuation journey, right? So for all of those who know it already, they might have a much better understanding, a clearer practical understanding from a different viewpoint. For all of those who don't know it, it is something new for you and you have to pay much more attention. Okay? तो इस पे ध्यान देते हैं दिस न्यूमरेटर कंपोनेंट व्हिच इज योर एंटरप्राइज वैल्यू ई स्टैंड्स फॉर एंटरप्राइज वैल्यू. So first of all, here we need to understand that what exactly is the enterprise value. Enterprise value exactly होता क्या है? So it is nothing but it is telling you the holistic value of a company. What is the total value of a company? Now, the total value of a company is different from the equity value of a company, right? There are two terms. One is the market capitalization and the second one is the enterprise value. If we talk about the market cap of a company or the market capitalization, it just takes into account the equity component only the equity component and not the debt component. Long-term debt is never included or no other adjustments are made. It is simply the number of outstanding shares in the company into the price. So if someone asks you that what exactly is the market capitalization of the company or what exactly he or she means if he says market cap, it is simply the number of the outstanding shares in the secondary market which are available for buying and selling into the price. So number of shares into their current market price is the market cap. And here the current market price is very important because the market cap of a company tends to change on daily basis. It might not change by billions and millions and lakhs, but it might change by a few hundreds, a few thousands, depending upon the market fluctuation. If the people are selling off that particular company, that particular stock heavily on account of some negative sentiment, as happened with the bank previously, a few days back, on account of some hedging practices, right? Some fraudulent hedging practices, like which the bank was accounted for, right? If such kind of negative sentiments or kind of negative news comes into the market, and the same can happen in the case of positive market news also, or positive sentiments also. So these can affect the market cap drastically by billions and millions of dollars itself. But every day the market cap of a company tend to change. Why? Because the number of shares might remain constant. It might remain constant, but the price at which they're getting bought and sold, it will differ. based upon market sentiments, because as discussed in the earlier valuation sessions also, price being a leading indicator, price tends to change, price tends to fluctuate based upon market sentiments, which can be positive, which can be negative, right? So market capitalization, or simply the market cap, it takes into account the equity component only. But if we talk about the enterprise value, it talks about the whole value of the company or the whole valuation of a company. For all of those who are well versed how to create a financial model for a company, you tend to calculate the free cash flow to firm, FCFF. Then you tend to discount the FCFF by the weighted average cost of capital, popularly being called as WACC or cost of equity. And then you tend to get as the enterprise value. You tend to discount the future cash flows. And you also tend to discount the terminal value. You add all those values and get the enterprise value for a company. Though that is out of purview of this session. For all the newbies, not to worry, like we shall be discussing how to create a financial model in detail in the subsequent sessions also. We'll be talking about FCFF, FCFE, WACC, cost of equity, cost of debt, CAPM, everything. And much of those sessions are already there on the YouTube channel, free of cost for everyone. Right? So ये सब videos बनाने में, ये सब चीजें करने में मेहनत लग रही है. So I would really insist everyone, right, कि चैनल को सब्सक्राइब करो, प्रेस द बेल आइकन, वॉच दोज वीडियोस, लाइक प्रोवाइड योर कमेंट्री. इफ यू वांट समथिंग टू इम्प्रूव अपॉन, आई विल डेफिनेटली वर्क अपॉन द सेम. सो वॉच दोज वीडियोस इन साइज तो जितना प्रैक्टिकली सीख सकते हो, बिकॉज आई एम ट्राइंग टू ब्रिंग द मोस्ट फ्रूटफुल कंटेंट, मोस्ट कॉन्सेप्चुअल कंटेंट एंड प्रैक्टिकल वे में चीजों को कैसे समझना है इन द मोस्ट सिंपलेस्ट लैंग्वेज, राइट? So if we talk about this enterprise value, so coming back to the topic, enterprise value, it takes into account the total value of equity of a company, the total market cap of a company. So this equity, it comprises of the number of shares into the current market price, plus the total value of debt of a company. And here we tend to include only the long-term debt, the long-term liabilities, which are bound to be paid after 1 year. Then you add the minority interests. Now, what exactly are the minority interests? Now, these are the minority shareholders who might be holding less than 5% stake in a company, right? So all those people who have a shareholding pattern in a particular XYZ company of less than 5% are the minority shareholders. Again, the weightage has to be paid to everybody equally, be it the equity, be it debt, be it the minority holders. And once you add all these things, you tend to subtract your cash and cash equivalents. Cash and cash equivalents. Again, the number of equity you can simply find out. Again, the number of debt is there in the balance sheet. Simply, the percentage of minority interest is also there as a liability section में अपनी balance sheet में. And simply cash and cash equivalents, a simple copy paste figure from balance sheet, right? So when you add this equity plus debt plus minority interest, you take the sum of those and subtract cash, right? Because cash is something which is non-operating asset, right? Because the income from cash is not a part of EV. If someone asks you that why do we subtract cash and cash equivalents, a very popular question in the interview, right? That why do we subtract cash and cash equivalents from the enterprise value? Because the income from cash is not apart from the enterprise value. The income from cash, it does not form part of the enterprise value. Cash is a non-operating asset. Hence, we tend to subtract cash out of it, right? Now, one thing they can ask you, if you find a company having a negative enterprise value, right? So this was the wholesome formula. When we try to understand much more upon financial modeling and valuation, then you sometimes tend to subtract the cross holdings also, right? And what do I mean by cross holdings? A company might be having multiple ownership patterns in subsidiaries into some other companies, and that need to be valued. And that component of valuation gets subtracted after the cash and cash equivalents, or like before the cash and cash equivalents, like it's just the same, but you have to subtract that component after adding these three numbers of equity, debt, and minority interest, right? But again, that is out of purview, right? But for the sake, I would say this is the formula which every analyst is following in the market. So ignore the component of cross-holding as of now. We'll try to discuss that in a subsequent advanced session. But is this equity plus debt plus minority interest? And when you add all these three components, subtract cash and cash equivalents. But do you really, if you find a company having a negative enterprise value, so that is very rare. You might not find any of the company, at least in India or US or I would say major developed markets or emerging markets, having a negative enterprise value. But if you find a company having a negative enterprise value, should you buy that company or not? One very popular question. So that might not exist practically always. And why will the company have, when will the company have a negative enterprise value? Company का ये number negative कब होगा? Company का ये number negative तब होगा when your cash and cash equivalents are a greater number vis-a-vis the sum of this equity plus debt plus the minority interest. Assumingly, if this equity plus debt plus minority interest is 100, cash is 200. 100 minus 200 minus 100 you get the enterprise value. So should you go for such set of companies where the whole component of cash and cash equivalents is greater than the sum of equity plus debt plus minority interest? Absolutely yes. Because we ultimately focus towards cash. अगर company के पास cash debt से ज़्यादा है, then it can pay off the debt. The quantum of cash the company has, which is much more than the market cap of a company, again, that is also very good. For most of the companies, you also tend to calculate something as cash to market cap or market cap to cash. It can be used interchangeably, right? So if a company is having a higher proportion of cash as compared to the market cap, though that will be in the most rarest scenario, but in the cash to market cap ratio, right? एक ratio बता रहा हूँ मैं, यही लिख रहा हूँ. It's like very important. Cash to market cap. इसके बारे में बहुत ही rarely people talk in the market. Very rarely people talk about this ratio, but this ratio is very important. And what's the reason why do people really talk about this ratio? Rarely, right? Because 90% of the companies might not have cash more than market cap. But if you can find such companies having cash greater than the market cap, be it from a large cap space, mid cap space, small cap space, micro cap space, it's a very strong company. So अगर cash to market cap किसी कंपनी का ज़्यादा है, it means the market cap is low. The basic mathematics, right? Your denominator is low and cash is high. Then go for that company. Sometimes this ratio is taken in a vice versa manner. That is, they take the market cap in the numerator and cash in the denominator. But anyways, in that case, the interpretation of the ratio tends to get reversed. But in anyways, we want the cash to be more. Also, if the percentage of cash or the proportion of cash is coming closer to the market cap, assuming the market cap is 100 and cash is 80 or 90% of market cap or 70% of market cap or maybe more than 60 to 65% of market cap, again, it's a very good signal. तो ऐसा नहीं है कि cash will always be more than market cap. In that case, also the companies are good. In that case, only the companies are good. And for all the 99% companies you find having cash less than market cap are bad. No. If the cash component is closer to the market cap, at least more than 60%, again, those companies are also really very solid. Correct. So this is the numerator, the enterprise value. And what is the denominator? This is your EBITDA. For all of those who do not know the full form for EBITDA, it is your earnings before interest, tax, depreciation, and amortization. E stands for earnings, B stands for before, I stands for interest payment that you are paying upon your fixed income obligations, a long-term debt पर जो तुम interest pay कर रहे हो. Tax, simple tax that you pay, corporate tax. Depreciation, which is charged upon tangible assets, which you can feel or touch, right? Like plant, building, factory, machine. Amortization is something which is charged upon intangible assets like patents, copyrights, which you just can feel, right? So इसमें क्या हो रहा है ना, in this component of EBITDA, you are ignoring the impact of depreciation and the amortization. So basically, if you want to calculate the operating profit of a firm, and what is the operating profit of a firm? The operating profit of the firm is simply your EBIT, the earnings before interest and tax. Simple formula hai, you take the total revenues and you subtract the total expenses from total revenues and you get this EBIT. So from that total revenues component, you are subtracting all the expenses, be it depreciation, be it amortization, everything. But if you ignore the depreciation and the amortization component, I mean to say, if you subtract all the expenses from revenue, company के सारे खर्चे you have deducted from revenue apart from amortization and depreciation. Ignore the amortization and depreciation is not there. वो numbers ही ignore कर दिए, right? But you subtract every expense out of revenues apart from excluding your depreciation and amortization. That is your EBITDA. Or simply, you can add back your depreciation and your amortization to EBIT. EBIT में, if you add back your depreciation and the amortization, you tend to get EBITDA, right? So this is how we tend to calculate EBITDA. This is your EV to EBITDA. You have the enterprise value in the numerator and you have the EBITDA in the denominator. Again, why do we calculate EBITDA? EBITDA का need ही क्या है? Because everyone is talking about your EBIT and mostly they talk about PAT, right? Where your interest has been subtracted and tax has been paid. Sometimes your dividends might have been paid too, but that is called as EACS, earnings available to common shareholders. Again, this term we have discussed in the price to earning का session. तो पढ़ लेना वो, ठीक है? So that is the thing. अब Again, this ratio, EBITDA, we calculate EBITDA is a measure of the cash profits of a firm. I'll repeat my point. EBITDA is a measurement of the cash profits of a firm. And what do I mean by cash profits? Your depreciation and amortizations are non-cash expenses. Your depreciation and amortization are non-cash expenses. That is, if a machinery or a building per se, or some kind of a patent or a copyright is experiencing wear and tear, decay, the money is not going out of your pocket. It is just the value of those assets is coming down. You are paying nothing for that, right? And that is why if the money is not going out, there is neither an inflow nor outflow of cash on account of depreciation and amortization. It's just a wear and tear, राइट कि कोई चीज घर पे खराब होती है, अगर ठीक कराओगे देन पैसा जाएगा, अगर ठीक नहीं करा रहे इज जस्ट अ डेप्रिसिएशन, राइट, और amortization. So it's neither a cash inflow nor a cash outflow in case of EBITDA, right? And that is why we tend to exclude this depreciation and the amortization. And that is why we tend to say it's a proxy of the cash profits of a firm, how much profits the company is earning on basis of cash inflows and outflows. Because revenues में cash आ रहा है, expenses में cash जा रहा है, right? So that is a measure of the cash profits of a firm. And again, this EV to EBITDA is very popularly used for all types of industries. Heavy industries में तो हम यूज करते ही हैं, like much more than price to earning, right? Cement industries, metals, oil and gas, infrastructure, all those kinds of heavy industrial companies. For drone manufacturing companies, your defense companies, all those kinds of companies which are heavy industrial companies, EV to EBITDA is very popularly used. And that is the biggest mistake which people tend to make, is they believe that EV to EBITDA is only used for those heavy industrial companies. Absolutely not. It is used for those companies, but also for IT companies also, because in IT companies, we won't have depreciation, but we will have amortization. Right? So also for light companies, which work more upon technologies, softwares, patents, copyrights, again, for those types of companies also, this EV to EBITDA ratio is used. And the major logic is, see, different companies might have different amount of fixed assets. Different companies might have different amount of tangible assets on which depreciation is charged. Different companies might have different amount of intangible assets on which amortization is being charged. So it becomes very difficult to compare all these companies on a similar parallels, because different companies might have different quantum of tangible assets and intangible assets. As per depreciation will be different, as per amortization will be different, and hence this EV to EBITDA multiple can be distorted, right? Because different companies के assets different है, be it tangible, be it intangible. So just to have a realistic comparison, we ignore this impact of depreciation and the amortization, just so we can compare the companies on a similar grounds. Because different assets command different amortizations and depreciation, and that can distort the number. It can make the calculations very tricky and might not give you the right number, right? So the fixed asset analysis is done by separate ratios: asset turnover, inventory turnover, fixed asset turnover, all those things, right? So all these things are meant separately, but यहाँ पे the why this ratio came into existence, because they wanted to ignore this impact of depreciation and the amortization, right? So this EV to EBITDA, again, like many people say, like if this ratio is less than one, it is undervalued. If this ratio is more than one, it is overvalued. At this time in market or in the subsequent future also, you might never find a company having an EV to EBITDA or any of the valuation ratio less than one, because multiples tend to re-rate. अगर आज हम बोल रहे हैं 20-25x price to earning is overvalued, after 10 years, 20 years down the line, that 20-25 का multiple will be a 10-year average, and that will become a fairly valued multiple. And 10 years afterwards, the company might trade at 30-35. What do I mean? For example, like if we talk about Nifty 50 का valuation. So Nifty 50 ka average 10 year, it's traded around like 20 multiple. It's currently been trading around like 18.8, 18.6. So, ठीक है, but it has also traded at 22-23x, right? So आगे जाके the average will not remain 20 forever. After 10 years, 15 years, the average might become 25. And 15 साल बाद, 10 साल बाद हम बोलेंगे पास्ट 10 ईयर का एवरेज तो 25 चलता है, अभी लाइक 30 पे काम हो रहा है. So multiples tend to re-rate as markets tend to rise, prices tend to rise, earnings tend to grow, multiples also tend to re-rate, right? So it is much better to compare based on 10-year averages only and not 20 years or 30 years. Some people tend to compare 30-year average, 40-year average, multiple 15 था, 14 था. It makes no sense because Nifty won't come down to 4,000, 5,000 levels, right? And same interpretation goes for price to book value, for EV to EBITDA and different ratios. That तो वही हमको समझना है. So it is basically telling how much your cash profits are supporting the enterprise value of a company. राइट। एंटरप्राइज वैल्यू के बड़े होने में कैश प्रॉफिट्स का कितना योगदान है, राइट। तो दैट इज बेसिकली द इंटरप्रिटेशन ऑफ दिस EV to EBITDA ratio. Sometimes what happens, they tend to use EV by adjusted EBITDA. EV by adjusted EBITDA. Again, it can be manipulative. Again, it can be manipulative. So before coming down to adjusted EBITDA, this EBITDA is something, see, many of the loss-making companies tend to come into place because आजकल the SEBI has allowed even the loss-making companies to get listed, right? The allotment towards the FIIs, towards the domestic institutional investors, the HNI का proportion is different उनके case में, right? But they have allowed the loss-making companies to get listed. Initially, they focus to be a EBITDA positive because they would be negative at EBIT, राइट। अगर वो नेगेटिव है तो पैड भी नेगेटिव ही होगा, कॉमन सेंस, राइट। So initially they focus to become EBITDA positive. Every time on news, some analyst comes into play, some market commentary comes into place, the promoter of the company comes into play, CEO, MD, analyst, research, valuation guys come into play. They just talk about this company has become EBITDA positive, EBITDA positive. Till this point of time, things are perfectly fine because initially the startup companies will make into losses because the depreciation, amortization might also be high. And उसकी वजह से हो सकता है कि उनके वो loss making हो जाए at the bottom line. And what do I mean by the bottom line? Your bottom line is your PAT. Your top line is revenue and bottom line is PAT. If someone asks you कि top line क्या होता है? Top line is revenue and bottom line is the profit after tax, PAT. Right? EBIT नहीं होता बॉटम लाइन, EBITDA नहीं होता बॉटम लाइन, पैट ही सिर्फ होता है बॉटम लाइन। एंड टॉप लाइन सिर्फ और सिर्फ रेवेन्यू होता है, एक्सपेंसेस नहीं होते हैं, ठीक है। सो दैट इज अ थिंग। अब that's fine because initially the company should strive to become EBITDA positive, and after a few years, once the gestation period is done, they can become EBIT positive or PAT positive on a bottom line basis, ठीक है। But the problem is sometimes their EBITDA is also negative for years and years and years, and they want to show to the public that they are becoming positive now. Because अगर EBITDA ही negative रहेगा सालों साल, then people won't be investing into such startups or loss making companies. They will say at least EBITDA positive तो हो company. अगर वो ही नहीं हो रही, then why will they invest their hard earned money for long term perspective? And because many of the HNIs, FIIs, domestic institutional investors, mutual funds, family houses are investing into the loss making companies because these are EBITDA positive and they can break even soon. Like many of them have already done, like Zomato and Paytm and Policy Bazaar, Nike, all that stuff. But the thing is, EBITDA positive वो नहीं हो पाती कुछ companies. And there they show a manipulated number, which might not always be manipulated, but there's certain things. And they calculate something called as EV by adjusted EBITDA. Or this EV calculation is just the same. It is the same EV as the above EV, but this EBITDA is different. This EBITDA is different. And how this EBITDA is different, I will just show you that page. See, this is something I took out from, yeah. So see, EBITDA tak we know. We have added back. Net income is the profit after tax. Interest add karoge, tax वापस add करो, you will add back depreciation, the amortization, you will get back your EBITDA. अब they're adding back your goodwill impairment. Now there are certain parameters which they tend to add or they tend to subtract, right? Okay. So what basically happens? If there is some gain, they will tend to subtract it, right? If there is some, I mean to say, if there is a credit, right? कुछ बेच के पैसा आ रहे हैं, that amount shall be subtracted. But अगर हम कहीं पैसा दे रहे हैं, it's a cash outflow, in that case, it shall be added back. Right? So what are we showing? We're adding back those expenses which can make this EBITDA positive. Sometimes क्या होता है ना, this abnormal EBITDA का number is negative. It might be minus 45.5K. And you have to make this negative number, यहाँ पे तो दिख रहा है positive, but assume करो, in a hypothetical scenario, this number is negative. So just to want to show to the public, they want to make this number positive. तो उनके जितनी भी खर्चे उन्होंने करे हैं, they tend to add back. जहाँ पैसा गया है, they tend to add back. And जहाँ से पैसा मिला है, they tend to subtract. So cash inflows are subtracted, cash outflows are added back. Some items like goodwill impairment, they've added back 15,000. Gain on asset disposal, asset को बेच के पैसा एक्स्ट्रा कमाया, 9.5K subtracted. There might be some litigation expenses, कोर्ट कचहरी के खर्चे, 350 add back कर दिया. इसको तो subtract करना चाहिए था, राइट। बट अगर ये सब सब्ट्रैक्ट कर देते EBITDA में से, then EBITDA तो और नेगेटिव हो जाता, EBIT तो और नेगेटिव हो जाता. स्टॉक बेस्ड कॉम्पनसेशन आउटफ्लो जा रहा है. Unrealized FX loss, there might be some foreign currency losses, 1.5. So they have added back all these things to make this EBITDA positive, right? Which can be manipulative, right? So see, other these expenses are one time because like goodwill impairment, gain on asset disposal, some litigation expenses, stock-based compensation, unrealized FX loss, they won't be recurring. They won't happen every month, every quarter, every year. So one time agar adjustment ho, it is fine. It's decent, right? But if these adjustments are being done monthly or quarterly basis, something is wrong. Sometimes what happens ना, ये adjustments का मैं share कर दूंगा, just ping me. ठीक है? Sometimes what happens, how they manipulate the numbers is, I'll just come back to the Word file. They calculate something called as EBITDA R. This R stands for rental expenses. अब rent तो company को देना ही every month. So sometimes they feel the rental expenses are much more than their EBITDA. And if they subtract the rental expense as a part of total expenses to arrive at the EBITDA, then EBITDA might turn out to be negative. Rent तो basic चीजें company को देनी ही है. The litigation expenses, gain on disposal of fixed assets, FX unrealized losses, these are like मतलब कि one time events, fine. But rental is a recurring expense. You cannot show it as a one time expense just to make your EBITDA positive. तो जो expenses होने ही होने हैं every month, जो खर्चे होने ही होने हैं, अगर उसकी वजह से EBITDA नेगेटिव हो रहा है, and EBITDA को वापस नेगेटिव से पॉजिटिव करने के लिए what they are doing, they are excluding this rental component. It's a manipulation. It's a fraud. These companies will have to see. They will say EV by EBITDA, EV by adjusted EBITDA. Fine, EV by adjusted EBITDA R. R जहां पे आगे extra it means it is adjusted EBITDA, right? So these things we have to see. कोई particular मान लो they might exclude some expense, some marketing expense, EBITDA RM. Again, they tend to adjust to make this number of EBITDA positive. And again, all these things you tend to find in notes to accounts, right? So that's the thing you need to see, correct? So that is basically your EV to EBITDA. तो वो चीज हमें समझनी, EV to adjusted EBITDA we need to understand. So all these things are very crucial, very very important for you to understand, right? एक लास्ट चीज बताता हूँ. In the next session we'll talk about price to sales, EV to sales. मैं ज्यादा लंबा नहीं कर रहा है सेशन को. EBITDA, right? EBIT by EBIT. See, अगर EBITDA से EBIT में जाना है, again you have to subtract your depreciation, amortization. इन दोनों का difference ही बस DA का component है, right? We know what is EBITDA, right? We know what is EBIT. To reach from EBITDA to EBIT, we need to subtract depreciation on the tangible assets and the amortization on the intangible assets, right? So that we have to do, correct? But sometimes we have to see this ratio of EBITDA to EBIT also, right? One logic I will tell you. I will just erase all this. For corporate finance valuation में ये चीज बहुत यूज होती है. This ratio of EBITDA to EBIT, which really people talk about on the YouTube channels, which really people talk about in the paid courses also. Social media बहुत कम लोग हैं, लोग बात कर ही नहीं रहे हैं. एंड तभी मैं बोल रहा हूँ सब्सक्राइब दिस चैनल, प्रेस द बेल आइकन, बिकॉज जो क्वालिटी यहाँ पे तुम्हें मिल रही है ना, आई कैन गारंटी यू कहीं नहीं मिलेगी. बिकॉज ये सब चीज़ें पीपल चार्ज करके भी नहीं बताते. तो अगर कोई इतने एफर्ट डाल रहा है, कोई ऐसी वीडियोस बना रहा है, आई वुड जस्ट रिक्वेस्ट एवरीवन टू वैल्यू दैट. शेयर करो जितना कर सकते हो अपने दोस्तों में, बिकॉज क्या बोलते हैं, ज्ञान बांटने से ही बढ़ता है, राइट? सो EBITDA divided by your EBIT. Now the thing is, if the difference or this ratio is less, when will this ratio be less? When the depreciation and the amortization component is less, because दोनों का difference is just a matter of depreciation and the amortization. If you subtract EBITDA from EBIT, the difference is your depreciation and the amortization का number, right? If the ratio is less, it means the component of depreciation and the amortization is less. So whenever this ratio is less, or the component of depreciation and the amortization is less, we can say the firm has a long-term sustainable advantage. The firm has a long-term sustainable advantage. There are various models to prove that. हम complexities में नहीं जा रहे, हम derivations में नहीं जा रहे, हम stats में नहीं जा रहे. पर समझने के लिए just have some extra knowledge, because it is not directly related, but indirectly related to this metric, right? So if the difference between EBIT to EBITDA is less, this ratio is less, that is your depreciation and the amortization component come hai, right? Competitive sustainable advantages can sustain for longer periods. That is your ROCE or your ROE per se. It will be greater than WACC. WACC is nothing but your cost of capital. कितना तो तुम खर्चा कर रहे हो. How much is the expected return on your investment is your WACC. ROC, the actual return that you get on your investment. There's a difference between ROCE and ROE. Very important metrics, बहुत important difference है. Again, I've discussed that in my YouTube sessions. वो देखो, ठीक है? तो ROE, ROC is the final actual return that you are making upon your investment, but WACC is the expected one. It's not the actual cost of capital, right? So if a firm is having lesser depreciation and the amortization, the sustainable competitive advantage can sustain for longer years. And whenever we mean sustained competitive advantages or core competencies, it means ROC, ROE is greater than WACC. For many years it can. For how many years it can sustain? There's a separate formula for that, right? Competitive advantages fading factor model. Again, उसको मैंने YouTube में discuss करा है, pre में, देखो उसको, right? And agar this difference is high, the depreciation and the amortization component is high, this ROE, ROCE will be greater than WACC, but not for longer time. Time period कैसे निकालते हैं उसका formula है out of purview, like watch the YouTube session for that, or like you have a separate video on that. But for sustainability period कम रहेगा. The ROE, ROCE will be more than WACC, but for lesser amount of time. If this EBITDA, EBIT factor, between the call it as a factor, right? अगर इसमें depreciation amortization is greater, and जब greater होगा depreciation amortization, right, और EBIT will be a smaller number. तो जब ये ratio बड़ा होगा, when this ratio will be high, the depreciation and the amortization factor again will be high, and that will mean sustainable competitive advantages are not there. So we want this fading factor, we want this multiple to be low, which will say that EBITDA से EBIT तक पहुंचने के लिए the margin is very less. It means depreciation and the amortization is low, and as the firm can sustain competitive advantages in future. So that's about additionally that you need to know about the EV to EBITDA metric. So we talked about EV to EBITDA, we talked about EBITDA to EBIT, we talked about cash to market cap or market cap to cash ratio, right? So again, समझ नहीं आ रहा, watch this again and again, pause the video, समझो. You can come back to me via my LinkedIn channel, via my WhatsApp communities, you can join those, right? We can learn, we can grow together. So that is a basic premise I would suggest everyone to go for. And do not forget to subscribe and press the bell icon. Thank you so much, guys. See you soon in the subsequent session.